Nice to have you with us on this Tuesday morning. Let's jump right into it and gauge the mood of the markets with our friend Scott Wren. He is a senior global equity strategist at Wells Fargo Investment Institute. I was saying, Scott, we're a little weaker this morning, but the mood seems fairly calm, and investors seemed pretty hungry for a little bit of calm after the wild couple of weeks we saw within the banking sector.
Well, I'd have to agree with you, John. I mean, I think everybody was ready for the weekend, last weekend that we just got through, and I'm ready for some calm here, and I think you probably are, and probably most of your viewers. So I would agree with that. It looks like, you know, whether it's what the Swiss have done, whether it's what the German government could do, whether it's what the Treasury and the Fed have done here. I think it has helped calm the markets, but certainly, we're not out of the woods yet, and I would expect after a little bit of calm, we're probably going to have some more volatility.
Yeah, that seems like the bigger question is, what does the road ahead look like, particularly on the economic front? Because while we've seen stabilization today, many people have made the argument that this turmoil only increases the odds of a recession. What's your view?
Well, I think it does. And really, the way that I look at it, and really, Chair Powell basically said the same thing, is he's like the likely credit situation where credit's going to be harder to get, especially at these smaller banks because of this turmoil. I mean, that's basically a substitute for rate hikes. So I think the Fed's very near the end of the line here. This banking turmoil is only going to serve as a headwind for the economy. We've had a bit of difficulty timing this recession, but we're certainly, while we're looking for an overall positive GDP, 1.1% is our number for this year. We're expecting a couple of quarters of negative GDP, so we do expect a recession. We think it's going to be moderate. And, of course, the market, it's calm now, but I think we're going to hit some more spots where we're going to be worried about, has the Fed done too much? Are they going to raise rates too much? All the typical things you kind of see at this part of the cycle.
The only challenge, well, look, there's lots of challenges, but with this comment that I hear from a lot of people, with good reason, that a recession is a concern, and it obviously raises questions around, stock market valuations. Can companies ultimately generate the same kind of earnings that they hoped to achieve if the economy continues to cool? The only caveat to that, we talked about it yesterday with Ed Clissold of Ned Davis Research, is that we're now about 15 months since the S&P 500's peak. And it is unusual to see this sort of bear sentiment leading before we actually get into a recession, which sort of begs the question, is there the argument that maybe stocks find a bit of a groove before potentially we see sort of the ramifications of that downturn? I mean, technology, for example, has been a sector that's been doing pretty well this year.
Right. It has. And you're right. This is the most, and if we have a recession, which once again we think we will, this is going to be the most anticipated recession, ever in the 35 or 40 years that I've been around, and it keeps getting pushed out. But I think that the stock market definitely expects some sort of at least a mild to moderate recession. So I don't think that would be a surprise. We keep talking about earnings numbers have more downside to come. But the thing is, individual company analysts have been really slow to adjust their rates because they're waiting for companies to give them guidance. They don't want to be outside the range, or the company's not going to answer their phone call when they call. But strategy guys and big picture guys like me, we've been looking at, our number's 205. I think the consensus for the top-down strategists, it's been 208, 209 for months. So I think really the market has adjusted for lower earnings. Now, there's some lower earnings out on the street. I saw, somebody, maybe has 190 or 195 number out there, something like that. But in the whole scheme of things, this would not be a gigantic contraction in earnings. And we don't have 2024 numbers out, but I think you're going to make up a lot of ground probably in 2024 in terms of earnings.
Okay, so when you have to sort of put a bow on it, a lot of people, the easy choice, I think, for a lot of pundits is, stay defensive right now, maybe focus on some short-term duration debt where you can get paid to wait, what have you. I'm looking at the S&P this year. I'm seeing energy stocks down 9%, financials, obviously the turmoil there, they're down 8%. What do you think about being invested in the equity market, even though there is all this uncertainty right now?
Well, we don't think there's a lot of downside here. We think it's kind of rangy. Let's say you get down to 36, 3,700 or something like that in the S&P. We think that's probably the floor. We want to be buying there. And if we get up, for the near term here, and if we're up at, 4,100, slightly north of that, we'd probably lighten up a little bit. So right now we're trying to play the range. We certainly think that this recession we expect is going to be short. So if we do get some downside here, I think, we're going to be pounding the table to probably take some positions that are a little less defensive than what, we've been defensive since March of last year, March, April. But, the time for that is likely going to change, and we're going to want to get more assertive over the next, let's call it 6, 9, 12 months, something like that. So I think we'd take advantage of the downside, look at it as an opportunity, and get a little more assertive, because we certainly think brighter skies are going to be on the horizon as we move from 23 to 24. The market's going to be ahead of that. We want to be ahead of that as well.
Scott, good to have you.